Good evening, everyone. Welcome to Let's Trade Live. This is Wayne, Head of Research and Education on behalf of Fullerton Markets. I warmly welcome everyone to our weekly webinar. So the webinar will be divided into 3 segments. The first segment will look at some of the events that has happened in the past 1 week, key events to take note of. And the second segment will open up the calendar for this week and look for any potential data to be traded or events to take note of. And finally, we'll move on to the final segment. We'll go to the charts. I'll take the requests from the floor and run through the charts to see if there are any trading opportunities. So let's jump straight to it. For last week, the first key event to take note of is basically Bank of Canada interest rate announcement. So they kept their interest rate at 0.5%. However, their tone in their statement, they downplay on the recent improvement in their economy indicators and also higher inflation. So he mentioned that this is due to rising oil prices, and also because of uncertainties surrounding policy changes made by President Donald Trump, and also highlight the country's economy is actually weaker compared to US. So to summarize everything, basically they are dovish. So this is to curb any speculation of a possible rate hike by Bank of Canada. So in the near term, at least, we are not expecting Bank of Canada to talk about rate hike because that's the bias at the moment. So this Bank of Canada. Next, of course, is Donald Trump. This is more of a political event, but we all know that political can have an impact on the financial markets as well. So basically last week, everyone is waiting for President Trump to announce the phenomenal tax cut proposal. However, as you can see over here, the highlighted portion of this Bloomberg report, US President Donald Trump's much anticipated debate address to Congress was light on the policy detail and big on rhetoric. So it means that his speech is more of persuasive talk rather than giving details on the exact policy that he wants to implement. So that's why that there wasn't much reaction on the market because no details has been released with pertaining to his phenomenal tax cut plan. Of course, the end of the week, which is after Donald Trump have not give any clear indication of his plan, the eyes of the market starts to shift to the Federal Reserve instead. So towards the end of last week, we have the Fed Chair Janet Yellen and Fed Vice Chair Fisher making their speech. So of course, as you can read the headline, Yellen hints at more aggressive rate path upon locking in March. So as you can see, the highlighted portion of this report, Federal Reserve Chair Janet Yellen left little doubt on Friday that the central bank will raise interest rates this month. More importantly, she dropped hints that it might end up having to increase them this year more than planned. That's interesting because last known, the Fed plan is to increase 3 times interest rate this year. So if it says increase more than planned, that means we are looking at 4 times a year, which effectively is once every quarter. So interestingly, so that's why last week there's a switch in sentiment. Prior to last week, the probability of a rate hike in March is only 40% or slightly lower. But after last week, within 1 week, there's a 180 degrees turn in the sentiment. So based on the Fed Fund futures, market is pricing in close to 90% or even higher chance of a rate hike in March, meaning to say it is almost close to a done deal even before FOMC. So that is the current situation and sentiment. So that's why we see dollar yen rally quite a fair bit, going beyond 114.50 before retracing back down on profit taking. So later we can go on to the charts to look at more trading opportunities. So that's the sentiment for now. Of course, the next thing we look at is basically on England side. So sterling has a sell off last week. Of course, the main key thing is because of the strength in the US dollar. So relatively, it makes the sterling weak. Of course, the other reason is there are speculation that Scotland may hold their second referendum for independence sooner than later. Although Scotland is only contributing to 6% of UK overall GDP, and the total population is about 8% of the whole population of UK. But if they eventually vote for independence and it goes through, then Scotland may leave UK. And of course, all this uncertainty, even though may not have a big impact to the actual UK economy, but such uncertainty is enough reason for the market to start selling the sterling. So of course, the other main key things to take note of for UK is towards the end of the month, UK Prime Minister Theresa May is on track to invoke Article 50. So for this, or rather from now until end of this month, we do foresee that the sterling is likely to remain under pressure. So that's key events that has happened last week. So we move on to the second segment. So let's look at the calendar for this week. So this is Tuesday, 7th of March. The timing on the calendar is basically based on GMT plus 8 time zone, which corresponds to China, Malaysia, Singapore time zone. Because there are a lot of people attending the webinars sending me email asking what is GMT plus 8 time zone. Of course, if you Google it, you will know that time zone belongs to which country, but for the benefit of the rest, GMT plus 8 corresponds to China, Malaysia, Singapore time zone. So the first one to take note of is tomorrow 11:30 a.m. It is a Reserve Bank of Australia interest rate decision. Of course, we do not expect them to change their policy. Just like what most of the market expected, they are likely to keep their interest rate at 1.5% at this moment. But the suggestion for traders out there is to prepare yourself in case there's any surprise decision made by the central bank to cut interest rate. So in this case, our suggestion is to put a pending short on Aussie dollar if the actual interest rate is less than 1.5%. So this is our suggestion. And of course, at the same time, do take note, after the interest rate decision is announced, the next thing that they will published is the RBA rate statement, which will detail out what's their outlook on the countries and the world's economy, and also to give the market heads up on what is their bias, whether are they confident of the outlook and they are expecting the inflation to go up, possibly looking for rate hike in future, that kind of statement. So for now, for this statement, it depends on what they are going to say. Of course, whatever they say may have an impact on the market as well. So for Wednesday, 8th of March, the data to watch out for is the ADP employment change. It is the ADP non-farm payroll. This is the unofficial non-farm payroll. So market is expecting 180K. So it depends on the actual data. And here are our suggestions. You can take either one. We strongly do not encourage a straddle order. Straddle means you put a pending long and pending short at the same time. The reason is because for ADP or non-farm payroll, be it unofficial or the official numbers, it is the most traded news and one of the most volatile news in the world. And during such news, there's a possibility of spread widening and sudden movement in prices, which may result in both pending order being triggered almost at the same time. It may not be at the same time, almost at the same time, because we may not have enough reaction time to remove one of them. So at the end of the result, you have a pending long and short, both orders being triggered, and you are locking in a loss. So that's the risk that we wish to highlight. So our suggestion would be for you to make a decision to take either pending order. Okay, if you feel that possibly the result would be surprised on the upside, that means then you choose the pending long order suggestion. But if you think that maybe the number will surprise on the downside, then you take the suggestion for the pending short. So for pending long, the criteria is if the actual figure is more than 199K, 199K, meaning it comes in 200K and above. Okay, I didn't want to put in a 199.9K. I mean, that's a bit too much. So wish to highlight, for this case, pending long dollar yen, if it's greater than 199K, meaning if the actual number is 200,000 and above. So why 200,000? It's a bit of psychology if you look at it from 100 over 1,000. Okay, even though it's 190, it is, to human perspective, it is still starting with a number 1. But once it crosses over just another 1K, the figure starts to change to 2. There's a psychological effect in a way. So our criteria is if the actual number comes in 200K and above, it is considered a very good number. And possibly we could see the dollar yen heading upwards on speculation that there are more rate hikes coming soon. Okay. Because as I mentioned, the current sentiment of a rate hike in March is already pretty high. It's almost 90% or even higher. So even a change of 90% chance to 100% chance, it doesn't make much of a difference. But if the number is really good, the market may start to speculate. Maybe the next rate hike after March would be earlier as well, maybe towards the end of first half of the year kind of thing. So if that kind of speculation start to price in, then possibly we could see dollar yen heading higher towards 115 maybe. Then of course the other suggestion is a pending short dollar yen if the actual number is less than 100k, meaning it comes in at 99k or lower. Then of course some of you may ask, Wayne, why such a big difference from a market expectation 180k to 100k? What if the number falls in between? Like for example, it falls 130k. In our opinion, we find that as long as the number is above 100k, dollar yen may not move much because it is quite unlikely to change the expectation of a rate hike as long as the employment figure is above 100k. That's our opinion. So that's the reason why we set a much lower criteria. If the number is really surprise much to the downside, less than 100k, then possibly to keep this pending short dollar yen suggestion. So this is Wednesday. Next we'll look at Thursday. Okay, of course the first one is on Thursday 8:45 p.m. This is the ECB deposit rate decision and also interest rate decision. Both figures will be announced at the same time. The suggestion is pending short euro dollar if both the numbers are lower than expected. So this suggestion is either one. So, but it's the same pending short euro dollar. So if the deposit rate or the interest rate or both comes in lower than the current rate, meaning ECB slashes interest rate, then possibly we could see a euro dollar heading downwards. So that's the reason for the suggestion of this pending short euro dollar trade. Then of course after the interest rate announcement, another 45 minutes later, there will be the ECB monetary policy statement and press conference where Mario Draghi will answer questions from the press. So of course whatever statement he has to make during that time will have an impact on the market as well. We do expect Mario Draghi to remain to acknowledge the improvement in the economic situation because data don't lie. Economic data is showing healthy growth in euro. But at the same time, he will highlight most likely express his concern in terms of the upcoming political uncertainties. This month we are seeing the Dutch having the first election, so they will sort of start the series of election that is coming for the whole of Europe. So much will be Dutch. Of course, Dutch, based on the current situation, that there's not much of an upset, or we are not seeing any speculation that there are candidates running or possibly winning the election and could result in how should I say, Holzit. Can't really find. We have all the Brexit, Frexit and everywhere. For Holland exit, most likely they will call it Holzit, but we are not seeing that kind of situation appearing or yet to appear in the election of Holland yet. But if there is a sign of the populists or signs of anti-EU sentiment increasing in Holland, then people may start to speculate maybe that kind of sentiment will spread throughout the rest of Europe. And especially with the upcoming election that follows after that would be French president election, and towards after the first half of the year would be Germany election, which is the top two economy EU. So there will be a plenty of volatility when it comes to euro. So we believe that Mario Draghi will, even though economy is showing improvement, but most likely he will keep his monetary policy on easing bias to so-called mitigate the political risk that is upcoming in the next few months. So finally on Friday, okay, in the afternoon, 5:30 p.m., that will be the manufacturing production UK. Market forecasts a drop in number, negative 0.5%. Of course, this is what the market forecasted. So our suggestion is if the number surprise on the upside, possibly pound dollar we will see an uptick in the pound dollar because pound dollar has been dropping quite significantly. Maybe a surprising good data may prop the pound dollar up in a short-term basis. So this is our suggestion, pending long pound dollar if the actual data comes in greater than 0.4%. Meaning instead of negative 0.5% like what the market expected, if the actual data comes in at 0.5% or more, meaning to say there are more manufacturing production activity rather than reduction, and possibly we could see a short-term rally in the pound dollar. So this is our suggestion. And towards the at night, 9:30 p.m., that will be the non-farm payroll, the #1 traded news worldwide. So of course, Fullerton markets will send out email to remind everyone the possible market volatility and risk that will involve if you choose to trade during those times. Do bear in mind and manage your risk accordingly. So however, this is our two suggestions for your consideration. It is similar to ADP non-farm payroll, if you notice. Because the market is expecting 180K for the actual non-farm payroll, which is quite close to ADP as well. ADP market is expecting 185K. So this is a market expectation. So our suggestion is if the number comes in greater than 200K, that will be our suggestion to go pending long on dollar yen. And if it is less than 100K, that will be our suggestion for pending short dollar yen. Again, we strongly advise we strongly discourage putting a straddle order, especially for the actual official non-farm payroll, which is known to be volatile. I personally have seen how non-farm payroll or dollar yen has moved up and down in a span of seconds of 50 to 100 pips in up and down. It's a whipsaw kind of thing in just seconds. So please take note and manage your risk accordingly. So this is basically our calendar for or the data to watch out for this week, or rather data that we suggest with possible trading opportunities. Of course, if you are taking trades during non-farm payroll, there are other two data to watch out for as well, the unemployment rate and the average hourly earnings. So of course, I try to make it simple instead of putting on too much criteria. Do watch out for, besides the non-farm payroll figure, sometimes market will watch out for unemployment rate as well. If it differs from the market expectation by a fair bit, then it will have an impact on the dollar as well. Plus the average hourly earnings, market is expecting an increase in 0.2%. Again, if the actual figure differs a lot from what the market expected, it means the wage growth of the people is not as much as expected. It could have impact on the dollar as well. So these are the data for this week. There's a question on my screen. Usually, what will be the spread provided by FM during the non-farm payroll? Rather, this is the spread that we receive from our liquidity providers. So the spread is not provided by Fullerton Markets because we are not a market maker. So whatever spread that you see on your platform is basically the spread that we receive from our liquidity providers. So before we move on to the charts, a quick reminder on our Accelerator Bonus, our most popular bonus. So for those of you who have yet to open an account with Fullerton Markets, I strongly encourage everyone to check us out, why we are popular with our traders, and also why is this promotion so popular. The terms and conditions are available on the website fullertonmarkets.com/promotions. Finally, we'll move on to the last segment of the webinar. And feel free to type in your requests, any currency pairs, symbols that you want me to go through, plus the time frame. Okay. So while you are typing in your requests, I'll run through the charts that we have gone through last week, a quick recap. The first chart is basically the Dow Jones. How many of you have made a killing over here? Suddenly all keep quiet. Quietly making money. It's okay. As long as I know you have made some, or caught this trade, made some decent profit, that would be great. Let's look at this. This was the Dow Jones. The vertical line is the time of the webinar. So I mentioned that two possible entry. One is if it closes above where the green box is, around the price of 20850. And the other one is a short so-called suggestion. So based on the chart, you will notice the short trade did not occur, did not fulfill the criteria. However, the long trade, let's look at the long trade. I'll zoom in to make the candle bigger. Okay, I'll put a crosshair. Of course, the green box, you have a plus minus of a certain range over there. So the middle is about 20850. So you notice if some of you treat this candle as fulfilling the criteria of closing into the green box, which it did, then you would have entered your trade in the next candle for a long. But even if you feel that it is still a borderline case, then definitely this candle will fulfill your criteria whereby it closes beyond the green box as well. So even if you have caught the trade and enter it at the next candle, which is around 2900 or 2901, whatever it is, doesn't matter. So this is quite a rally upwards. If you see the figures, it is 25,000 points for Dow Jones. So I'm not sure how many of you trading Dow Jones have caught this move upwards. I sincerely hope that some of you have caught at least some of it, because it is quite a big move. And if you have applied trailing stop to your trade, it is even better. So you will notice that the price shot up all the way with a little retracement. So meaning to say, if you trail it, chances is you will caught quite a fair bit of the movement. and until price pause over here. So this is 1, 2, 3, 4, 5 candles whereby prices pause and fail to go higher. And this is a 4-hour chart. 5 candle is 20 hours of price movement. So within the 20 hours, if you take note of this as a price pause, possibly you would have trailed your stop to just below where the price pause. So in the event if the price goes back below, you have reasons to suspect maybe profit taking price will start to come down to exit your trade. So let's, if you take, for discussion's sake, if you have put a trailing stop really at about 21060 level, that would be almost 16,000 points of movement or profits over there. Anyway, this is Dow Jones that we have looked at last week. The next chart that we looked at is basically oil. So for oil, I mentioned that possible look for bearish candlestick pattern to go short. Vertical line is at the time of the webinar. So you will notice the price after 1 week, it is still trapped within the upper and lower boundary. So the green box is suggestion for entry to go short, and of course the first target over here, and then second target over here. So let me zoom in and take a look what exactly happened. So this is the situation. Okay, there's a long. I'll zoom in further so it is clearer on your screen. So you'll notice this long bear candle. Yes, it fulfills the criteria of closing below the green box. However, it is quite near to the blue box, which is the first target. This is only like 20 over points lower. So theoretically, even if you enter at this trade, by the next candle, you will see the shadow going down to the blue box. So of course, some of you who may think that, well, the shadow is so fast, how do I manage the position? Remember, this is a 4-hourly candle. So even though you see a shadow, that shadow will be around that price for within that 2-3 hours time span. So within the 2-3 hours, if you spot that the price just touched the area and retrace back upwards, then this is a clue for you to get out from your trade, because it has already reached our first milestone. So technically speaking, once it reached the first milestone, the bare minimum that I would do at least would shift whatever stop loss it is to my entry price, or even lock in a few points of profit. So this spike would have resulted in exiting the trade at almost or at break even. So it is quite a fair bit fast move. So this is oil. So of course, some of you will start to think, oh, what if you enter a trade and you really put a very conservative stop loss, which is way up here. Okay, a conservative one, it is way beyond the range. That would be a conservative stop loss. And there you would exit at the second target over here. So even if such a trade, the risk reward is not really that favorable, it is maybe 0.7, or rather one risk versus 0.7 of profit. One portion of risk. For every dollar that you risk, you will get 70 cents, that kind of ratio. So, but for me, it is a break-even trade because of this spike. Once it reached the first target, if the price retraces back up, that's my clue to exit and look for the next trade. So that's oil that we have looked at. The third chart is basically a pound dollar. So I mentioned that because of a slew of US and UK data, I prefer to apply news trading strategy on this pair for last week instead of technical trades. And finally, Aussie Yen. So this is the Aussie Yen trade. So this is an interesting case study as well. So again, suggestion, as you can see over there, the green box for a long trade. So once price close beyond, that will be the clue to go long, at least for me. So on the next candle, I would next candle over here, at the opening of that candle, okay, indicated by the red arrow. At the opening of that candle, that would be my signal to go long. So of course, within how many candles? 1, 2, 3, 4, 5, 6. About 6 candles later, you see a spike downwards. So if I've placed my stop loss just lower than the candle that broke above, where the red area is, okay, yeah, red area will be typically my stop loss. Or even if I put a conservative stop loss, which is somewhere here, the low of the another candle prior to it. So regardless of which stop loss, you will notice that you will still hit because I'm wrong in my trade. So this is a classic situation of a stop loss trade. So this Aussie Yen for me last week. So let's look at quickly move on for the suggestion this week. There's a question, could I provide my analysis on dollar yen H1 for this week? Sure, I'll look at it. Let me see if there are other questions that I should take note of. No, they are all requests. Okay, let's look at the first request, which is Aussie Swiss franc H4. Okay, let me open up the Aussie Swiss franc H4. Okay, this is Aussie Swiss francs. Let me zoom in the chart. This is the current candle. Okay, Aussie Swiss franc. For Aussie, do watch out for tomorrow. Definitely, although we are not expecting much changes in the interest rate, but their rate statement will definitely have an impact on the Aussie dollar. So if it impacts Aussie dollar, it will definitely impact this pair Aussie Swiss franc as well. So if you ask me what is RBA going to say, unfortunately I don't have that foresight to expect what they will say, or rather I prefer to react to what they say. So if they are hawkish, of course, the Aussie Swiss franc is likely to head upwards. And then, of course, if they are dovish or very dovish, we could possibly see Aussie Swiss franc heading downwards. So from now until tomorrow, whatever I'm going to indicate on the chart, it will be based on technicals. But I will only apply it after the RBA rate statement. So most likely, instead of looking at H4 chart, we have to switch it to a lower time frame to look for entry. Reason is because when RBA made the statement, market will start to react. So if you look at H4 chart, the reaction is all maybe within 1 H4 candle, because there's a 4 hours time frame. So to catch that kind of movement after the statement, chances is we have to lower the time frame to hourly chart, or maybe even the 15-minute chart. So from now until tomorrow, we do expect this resistance to hold, unless markets start to speculate RBA may be more hawkish than expected. Then prices may start to creep up before the RBA announcement. So let me zoom in to make the candlestick bigger. So the criteria over here is so that's my criteria, whatever that I'm going to say on the chart. The first one is whatever my entry criteria is, it will be applicable after, not before the RBA statement. So if the candle close into the green box, okay, and the green box is about plus minus 1 or 2 pip, which is fine. 7684 plus minus that 1 to 2 pips. This is hourly chart. So as long as it close into the green box or beyond, that would be my signal to go long. And of course, for the short trade over there, for the short trade, maybe it will fulfill the criteria before, because it is quite close. It may fulfill before the RBA so-called announcement, which is about 12 to maybe 14 hours later. So if it goes to the lower green box there, it fulfills the criteria, but like I say, my entry criteria is only applicable after RBA statement. So if price really creeps down to the lower green box here, I will not enter, because it is still before RBA. So if that really happens, then the other possibility to go short for me would be here. If candle close lower, at the lower green box there, that will be my signal to go short as well, which is around the price of 7629 plus minus. Okay, so this would be my so-called suggestion for Aussie Swiss franc. So this Aussie Swiss franc. The next request The next request would be pound yen H1. Pound yen H1. Let's look at pound yen H1. Okay, this is a H1 chart. This is the current candle. Okay, just let me look at the higher time frame. Near term, the bearish momentum is still keeping it down, as you can see over here. Okay, that's just for visualization purpose when I draw the trend line. So this is 4-hourly chart. I'm going to switch back to hourly chart as requested by our dear friend. Okay, vertical line is the time of current candle. So I'll mark some levels which just give me a moment. $139.60, that would be one of the suggestion. Okay, now prices retrace after a sharp drop. It is retracing back up. So a bit of price action trading over here. Very simple. I'm zooming in so that the candle is big enough. Later I'll zoom up for you to see the label again. So this current candle, if it closes below which is about 139.46, about there, 45, 45. Okay, if it closes at 139.45 or lower, that would form a bearish engulfing pattern over here where the green box is. So once it closes below, that will be a signal to go short. My signal to go short. Yeah. So I'll put my comment here. So if a bearish engulfing pattern forms, so if a bearish engulfing pattern forms, that is my short signal to go short, and I'll place my stop loss slightly higher than the decision region. Where the red box is. Of course, factor in the spread, because if you are after taking a short trade, your stop loss should factor in the spread, because if the tail or the shadow reaches here with a spread of maybe 3 pips, it will trigger a stop loss that is 3 pips higher. So if you factor in a spread, that would be about 13980 as well. Okay, that would be roughly the stop loss for this trade. And of course, the first target. Pardon me for zooming in and out, because I need to gauge where, to see enough candles to gauge where is possibly the first so-called target for me at least. But I'll still zoom in for the benefit of those attending at home, so that it is clearer, easier to see with a bigger candle. So I'll mark with a blue box. That will be the first, oops, that will be the first milestone over there, where the blue box is. And the price of the blue box is about just before it hits into the round number of 139. So again, if you notice, for short trade, even your profit target will also have to factor in the spread. Meaning to say, if you put your profit target at 139.06, the price has to go lower to maybe 139.03 before it will trigger your target. So that's because of the spread. So for this trade, it is, if you do a measurement of the potential entry to the potential stop loss, it is almost 1:1 risk reward for the first target. So of course after the first target, for subsequent target, I will apply my usual trailing stop technique to write as much as possible. If not, if market retrace back to my trailing stop, then I'll exit the remaining position. So this is pound yen. Short so-called suggestion. Next currency pair is actually CAD yen. Interesting, another yen pair. Oh, then after that I need to go on to dollar yen. Oh, we are looking at all the yen pairs. Let's look at CAD yen. CAD yen H4 chart. So this is CAD yen H4. So what you see over here, CAD yen H4, the downward momentum with very big upswing. It is quite volatile if you look at whatever happened this year since January. So you notice a sharp drop and bounce up, another drop, bounce up, another drop to a new low. So now price is quite near the decision region again, interestingly. So let's look at, I'll zoom in. This is 84.90 round number. Okay, so that's the decision region that I'm seeing. So I'm zooming in. Okay, I'm adjusting the trend line. Just give me a few seconds. Okay. So price is near the decision level. So there is a small gap over here from the opening to the close, the Friday close to the Monday opening. There's a small gap, not big. It is less than 20 pips. So, and the price is heading downwards. So if the candle closes into the green box or lower, that would be my signal to go short. So the price is about 8476 plus minus. So once the price close into the green box or lower, that would be my signal to go short. And of course my stop loss would be over here. Or a more conservative one, which reference the high just before market closes last week. So this is one is tighter stop loss, which is around 85.23, or a more conservative one which is higher, which is around 85.50. So the tighter stop loss is about 47 pips. The more conservative one is about 75 pips from the green box area, plus minus. And then of course the first milestone would be over here, just slightly higher than the potential support. So that will be the first milestone, around 84.33 or 34. So there is a CAD yen. If it closes into the green box lower, that will be a short, and the first milestone is over here. And of course, after the first milestone, as you can see, the H4 chart, after the first milestone, there's no reference of the next support that is lower than 84.34. So one option is scale it one more time frame higher, which is the daily chart. There you are. So on a daily chart, possibly you could reference the next milestone, which is around 83.33. So that is about 100 pips lower than 84.34. So that's one way. You scale your time frame higher to look for the next reference. Alternatively, the other method that I personally also use is I just look at the price action after 84.34. So if price really drops below 84.34, then I'll look at candlestick, look for short body to identify pauses in prices, and I'll take that as a reference to trail my trailing stop. So that will be CAD yen. Oops. On a short bias. Of course, I will be a bit wary of going long, at least for now, because if the price close above here, technically speaking, it is sort of my entry to go long. But looking at how the momentum is pushing it down, I do expect if the price retraces upwards, there will be a limit on how high it will go before coming down again. So for CAD Yen, there are not much data affecting CAD Yen, except if you look at the calendar. If you go to FX Street calendar, you will see that towards the end of the week, Friday night as well, there's a series of Canada employment data as well, and possibly that will have impact on this pair, but that is already towards end of the week. Okay, so this is CAD Yen, and let's look at the dollar yen. Okay, we have come to the last yen pair on the request list. Let's look at dollar yen. Dollar yen H1. Okay. For dollar yen H1, of course, if you ask me, a lot will be riding on the ADP figures and the non-farm payroll figures towards end of the week. So these figures will be the main driving force for dollar yen, if you ask me. But of course, it doesn't mean the dollar yen will not move before and after it. There's still so much trading hours available. So dollar yen may still move, but most likely it is limited unless there's some so-called significant trade being triggered, which we will not have any transparency to. Like for example, if certain bank does a big trade, then momentarily that may move the price a couple tens of pips, maybe 20 to 30 pips in an instance. So those kind of situation is possible. So it doesn't mean there is some news or data being leaked out that causes the price movement. So having said all this, dollar yen hourly chart, you can still do whatever technical trade, but like I say, I don't expect big movement before ADP and before the ADP non-farm, and also before the actual non-farm payroll. I don't expect big movement. So my suggestion is, if you do any technical trade on dollar yen this week, try to maybe exit fast with small profits. Of course, the main reason is I don't expect dollar yen to have big trends before the key data is out. So if you look at how price move, it is really pretty tight. Okay, let me zoom in. You notice this is like on an hourly chart, 20 over pips of movement. This is 70 pips, which is last week. Okay. It came crashing down after Janet Yellen's speech. So it is typically buy the rumor, sell the news kind of situation. So this is profit taking towards the end of the week. So price starts to creep down. So of course, closer to the week, if the data is good, then possibly price will start to head upwards towards 114 or higher. So 11390, if the prices close higher, that could be a potential entry to go long. Too low. maybe 113.98 thereabout. A bit tricky because there's another region over here. So basically, as you can see, the area that I marked is basically the zone around the round figure of 114. Okay, 10 pips above round figure 114 and also 10 pips below 114. So this is a tricky entry area over here. Decide to remove it, doesn't look good at all. It is trapping within the round number. I would be more comfortable if it goes here before taking a long position. $11420. This is the current candle. So of course, if you ask me the short, to short dollar yen, I'm not so keen on shorting dollar yen unless data is really bad. So that would be for shorting the yen would be based on data. So for shorting this pair, I would prefer pending short during ADP and or NFP, expecting bad data. So expecting what kind of bad data, I think I've already highlighted in the calendar, so you can refer to it. In case you're wondering, when I say refer to it, the webinar is recorded. So for all our Fullerton clients, all you need to do is log into Fullerton Suite, click on videos and select Let's Trade Live. All our past webinars are archived inside with the most recent webinar on top. So it's easy for you to access. So that's another value add for being our Fullerton client. Yes. So there is my comments on dollar yen. So the next, one of our attendee mentioned that there's no sound. Apparently, I believe it is only you having sound issue. Maybe you want to have to check on your speaker, because I only receive a no sound comment from you. So you may want to check on your speaker or maybe your internet connection. Okay, anyway, I'll proceed. The next instrument or suggestion request would be Kiwi dollar H4. Okay. Kiwi dollar H4. Let's look at Kiwi dollar H4. And this is Kiwi dollar H4 chart. I'll put in the vertical line over here. There you are. very sharp drop. Of course, it is very much a dollar strength over here with a rate hike expectation next week. So of course, the data this week will have an impact on this pair as well, because it impacts the dollar strength. Of course, short term, if you check the news calendar in FX Street, you will notice some other data that they may affect Kiwi as well, like the GDT, Global Dairy Trading Price. So to take note, you can access the calendar via fxstreet.com and check when is the GDT, when the GDT will be announced. So take note of that. That will have an impact on Kiwi. So in any case, for Kiwi dollar, after a sharp drop, you notice the price is more or less consolidating over here, short term for the last 24 hours, 24 trading hours. Yeah. So where my this is where the consolidation happens. So let me mark the boundary. Very nice round number, 70.45, sorry, and 70.10. Of course, if you look at this number, it is very near a big round number of 0.7. Very big round number. So let's see how market reacts to this very big round number. So what we have is 4-hour chart. Let's go to higher time frame to have a look. So this is how price has been reacting around the round number of 0.7. Of course, they have all these spikes protruding out. Market is never perfect. So move the wrong line. But it gives us a certain perspective on how prices has sort of respected the 0.7 area. So over here, so it gives us certain clue that the price may still breach 0.70 in a short term before retracing or reversing. So that is the conclusion we can form around 0.70. So how we can apply to trading? Now I switch back to H4 chart. Oops. Okay, now I'm switching back to H4 chart. You will notice that even if you go short, prices may reach slightly lower, which is maybe 0.6980 based on past historical occurrences. But after that, that is the clue for us to either exit or do a trailing stop, but at least shift the stop loss to entry price. If the price reach the blue area there, that will be the signal for us to shift our stop loss to entry price if we are in a short position. And at that area, I personally will not exit entire position, because if the price survive that kind of move beyond, chances is it will go much lower. So I as a trader would not want to miss out that chance to ride that. So I would just shift my stop loss to my entry price and wait for it to happen. If it doesn't, price retrace up, I'm still out of the trade without a loss, which is fine. But if it really does go further down, then I'll be ready for a good ride. So at this moment, the price is still in a consolidation. A bit tricky to decide an entry for short, because if it happens, most likely the shorting price would be at 0.7. And then it will be quite a risky thing to short, and if the price hit another 20 pips downwards only and reverse up, chances is it will hit my stop loss. So in this case, I would rather wait for price to either retrace higher to give me a better entry for short. But if price retrace higher, then the only possibility is bad data from ADP and non-farm payroll. So if it is bad data from ADP and non-farm payroll, then we may want to give it a second thought before shorting it. So that's my thought process for Kiwi dollar. Besides considering technical and taking into account the things that could possibly happen on the fundamental side, and with the news and data, I do find Kiwi dollar a tricky pair to trade, at least for this week. So I prefer to take the trades of the other pairs that I have shown, at least the 4 charts that I've gone through, instead of Kiwi dollar. Although it is in a nice trend, but the main reason it has hit into a big round number. So whether would it, I believe that it will take a rate hike from the Fed before the Kiwi dollar can breach this round number, and that could only happen next week during the FOMC. So let me move on to one last request before I answer the questions. There are some questions on my screen. The last request that I will handle. Again, due to time constraint, if I can't take your request, my apologies. But no worry, there are many more webinars upcoming. I will definitely take your requests in one of those webinars. So anyway, Go is the request, H4 chart, and this is Go. So Go has been on the rise since early this year. Main reason is because there are a lot of uncertainties surrounding the world. Europe, there's a lot of political uncertainty, and after Trump sworn in as US president, there's also a lot of uncertainty surrounding the policies and the impact from his policies. So with all these uncertainties, it favors the safe haven gold asset, so pushing the gold price up. Plus, there's a lot of speculation that there may not be a 3 rate hike from Federal Reserve this year. Maybe they are scaling back to 2 rate hike. So all these reasons so-called fueled the rally in gold since start of the year. Of course, last week there's a switch of sentiment. We are looking at a high chance of a rate hike in March. That's why you see the gold price dropping, because the US dollar strengthening. So in our weekly research, we actually highlight this. So I'll take this chance to highlight it again. So on our weekly research, we actually put on the indicator of stochastic to give us a more objective way of taking a position in gold. So over here, we are waiting for stochastic to give us a sell signal once it goes above 80, which is the overbought region. highlighted in the green box. So we are waiting for stochastic to hit to the above level to give us a short entry. So this is the current candle. So I'm going to zoom in, and of course for those of you who trade divergence, possibly there is one that is coming up. Still unsure, because unsure in a way it is almost confirmed that this would be a divergence, because the stochastic high is already getting higher. But until the current candle closes, then it can be confirmed, because if the current candle suddenly turns south for a long bear candle, chances is the stochastic will follow to turn down as well, and that may change the divergence pattern. So for now it is still forming. So if the price push further up, that would give a so-called bearish divergence for short as well. So to make it simple, if you are not trading divergence, never mind, but if you are trading, that would be something to watch out for. If you are not trading divergence, a suggestion is wait for stochastic to go above 80 to give you a sell signal. So that will be for gold. Okay, possible sell signal once stochastic hits above 80. Okay, let me take a look at the question. Okay, there's one question. How does the housing sales figure or the number of mortgages of a country affect the forex industry? The housing figures and the mortgage figures reflect the health of a country economy. So it does not have a direct impact on the forex industry, but rather it is an indicator to tell us how well the country, the domestic economy is doing. Housing sales is very simple. If people are doing well, they will look to invest in housing and real estate, and chances is more people are buying houses. And number of mortgages, meaning people taking loan to buy houses, because if people are optimistic, then they will take loan to buy houses. If the situation is gloomy, things are not doing well, consumer are a bit wary, then chances is they may not take risks to take loans to buy houses, because what if they can't pay off and things like that. So these are the figures to tell the state of health of a country economy. So if the country economy is doing well, then the next thing, most likely central bank may look into tightening and increase interest rates, which will affect the currency market. So it is more of a chain effect. Of course, housing sales and number of mortgages is just a piece of the puzzle. There are other things to look at as well to gauge how well the country is doing, and what is the central bank so-called bias is, or where is their focus at that point in time. So hope that answer your question. The next question, if we short gold, do I buy or sell dollar Swiss franc? To me, it is a different instrument. But if we look at it from a point of view that they are both paired against US dollar, then of course if I sell gold expecting dollar to strengthen, then for dollar Swiss franc I'll be looking to buy as well. So sell gold, buy dollar Swiss franc. But that is just looking from the perspective or treating both as a dollar peg against dollar instrument, but not forgetting dollar Swiss franc. That's the other side of the equation, which is Swiss franc. So of course, at this moment, Swiss franc is pretty quiet or pretty neutral at the moment. So a lot of the driving force for dollar Swiss franc is actually the US dollar. So in simple terms, for now, if you ask me sell gold, it would mean more or less buy dollar Swiss franc. This is a correlated trade at this moment, if you ask me, based on the current situation. Okay, so we have time flies. Again, it's time to say goodbye. So before I end off, there's a short announcement. I'll be traveling to Sabah. I believe some of you are listening to the webinar. Yes, I'm traveling to Sabah to meet some of you next Monday evening. So we will not have a webinar. We will still produce the weekly research. So do watch us out on the weekly research. That will give you a fair idea of what I'm going to talk about if I have a webinar anyway. So even though without the webinar, do watch out for the weekly market research, which will be made available on Monday, maybe around noon time on our website. So check us out, and there's some our picks and some trades suggestion as well, highlighted in the weekly market research. So on behalf of Fullerton Markets, that's the end of this webinar. We wish everyone a good night, and may the pips be with all of you. This is Wayne signing off. Look forward to seeing all of you in the next webinar 2 weeks later, same time, same channel. Good night and bye-bye.